When it comes to getting out of the rat race, passive cash flow is king. But what do you do when the risk to reward ratio on rental properties is too small? One powerful proven option is private notes. In this episode of Main Street Capitalist, we'll visit with a 45-year veteran and legend in the business and discover the power of private note investing. Stay tuned. Welcome to the Main Street Capitalist Show. I'm your host, Russell Gray, and I am still on location here in Arizona, Phoenix, Arizona, at the Assisted Living Conference. And in some ways, it's kind of like old home week. And so the world is beginning to discover this asset class, this space. I've been covering it for about 10 years now, but this is the biggest conference they've had so far. A lot of enthusiasm, a lot of excitement. I probably don't need to tell you, depending on when you're watching this. It's been a little bit tougher in traditional real estate, but these are high-yielding houses. And most people think about it from the equity and the cash flow point of view, but there's another side to the real estate business, and that's the debt side. And we're not talking about being in the mortgage business. We're talking about dealing with private notes. And today, I have the king of private notes with me, a gentleman you may have heard of, but if you haven't, you're about to meet Eddie Speed from Note School. Eddie, thanks for joining us.
Thank you.
Yeah, so for people who don't know who you are, and so that I don't butcher your resume, I mean, you're a bit of a legend in the space. You've been an educator for a long, long time, very active entrepreneur and businessman in this space, teacher, probably given birth to a lot of people. In fact, a friend of mine was a student of yours, and we actually ended up doing some work with him at the Real Estate Guys radio show when I was there. So tell folks a little bit about the business you're in today, what you're doing.
Well, I teach people how to buy essentially first mortgages on property. It could be a house or it could be land primarily. And these are performing notes. As the non-performing note progresses, and that there's going to be some of that for sure, then we obviously have a lot of experience in that as well. I started in 1980. My specialty is, while I've dealt in other types of mortgages, my specialty is seller financing. And we're very active in that space. We've to date closed about 50,000 seller finance notes. So we're still in the space, and we're just teaching people essentially what we do.
Okay. So for people who aren't 100% familiar, I'm going to kind of bring it down just to the basics, and we'll shoot through that real quick. And I'll tell you what I understand, and you correct me if I'm wrong, because I may get it wrong. I have a background in the mortgage business, but I was a mortgage broker. So I was going to, the traditional markets and originating markets that are going to get sold in the secondary market and blah, blah, blah.
Yeah.
In your case, somebody sells a home and they carry back the note. The owner carries back the note.
Right.
And then this note is available. A lot of people don't know that even the holders of those notes don't know those notes can be liquidated. You can sell them. You don't have to wait to get paid back by the borrower.
Right.
And so talk a little bit just about that from the investor perspective in terms of how do you find these things? Why would you want to buy them? I taught the finance module for the California Association of Realtors for a little while, about 20 years ago. And one of the modules that I taught was discounted notes. And I think sometimes people look at the note rate and they think that's the yield, but it isn't. So I think help people understand that there's actually equity in debt. And I think a lot of people don't understand that.
So most of my clients that I work with are professional real estate investors. I've not had consistency in dealing with just a mom and pop that owner finances a property. So I usually deal with people that do it over and over. They generally have flow business or a portfolio, but they need to sell that note or part of that note in order to get to liquidity, to go do the next deal and the next deal. So that's exactly what we help them do. Notes are, some notes are discounted, some notes aren't necessarily discounted so much. It depends on, is there something wrong with the note? Is the rate too low? Is their loan to value too high? Well, maybe that note needs a discount, or maybe they just did it right and they don't have to discount it very much. So, but the idea here is landlords, that most of our clients today are looking at this versus landlording, right? The problem is, if you went back in 2018, probably in 85% of the cities, the profit on a house before you pay the bank was probably about 8% per year, right? Today, that same house is 4%. And so landlords are not having the great success with rentals that they were. And then we say, well, why don't we show you how to seller finance the same house? And instead of making 4, you could make about a 10% per year.
So somebody goes in, they buy a house, they get it up, rehab it, make it better. They go to sell it, but instead of the person getting a conventional mortgage, they're going to carry back a note and then produce a stream of income without any of the equity risk, without any of the landlord risk. They just have the counterparty risk, but it's secured by the property that they just got done rehabbing.
Right. And the cash flow is so much better. Like, it's just a lot better. And you're selling it to a specialty buyer, but not an unrealistic buyer. You know, about 40% of the mortgage industry today sells to people that are non-Fannie Mae, non-Freddie Mac, non-FHA buyers, right? It's called non-QM loans.
Yeah.
And that's the target. And these people are underwriting for like Fannie Mae and Freddie Mac is very rigid. And so they're somebody that doesn't necessarily meet their standards, but they're an excellent buyer. And we've been buying that customer for 40 years. We know them well.
Did that business get better after Dodd-Frank and after it became a lot harder for people to qualify for conventional mortgages?
When underwriting got tight was when the virus happened. Fannie Mae and Freddie Mac, they have a mortgage credit availability index, they call it. Mortgage Bankers generates this. And it was about at a 185 the day the virus started. Today it's at 100. And it stayed at about 100, up or down a little bit. But so that means that literally about half the people that could get a mortgage, you know, in 2019 can get a mortgage today. So we just feel like it's left a lot of deserving buyers left behind.
Yeah. Okay. So if I'm a real estate entrepreneur, I'm out there finding distressed properties. I bring them up to speed, very good for the neighborhood.
Yep.
I have my capital invested. Now I want to produce a stream of income, so I sell the house on the open market for a higher price.
Not necessarily. Market price.
Market price, more than I bought it for.
Sure,
probably.
Yeah.
Right? And then I'm going to carry back the note, first position, secured by the deed of trust. They make a down payment of some kind?
Yes, absolutely. At least 10%, and I say that the average can probably be 15% down.
Okay, so you have a little bit of protective equity. Got a pretty big note, pretty good payment.
Yeah.
You're not competing with agency money, because if they could get that, they would have gotten that.
That's
so
right.
You're going to get a little bit of a premium on that, on the note rate.
That's right.
Okay. So now I've got this stream of income, and if I have enough investment capital, I can just continue to do that. It would be a way to deploy capital into properties, increase my capital base through the rehab, and then develop a stream of income.
Right. And so what I've sort of done on the trading side is I built a marketplace. So they can go sell part of that note. They could go sell all of the payment, or they could sell 80% of the payment.
So let's get into that. I took a class, a creative class, way back in the day, and they sold me a little 3.5-inch floppy disk for like $1,700 in 1995. It was like as big as my house payment.
Yeah.
And I got it, and you put in the little numbers, and when I'm in the seminar room, it seemed like the greatest thing. But you know, having the ability to do that is interesting. Having the marketplace and a network of people where you have buyers and sellers is something completely different. But one of the things that I got introduced to there too, so just kind of representing the Main Street layperson who's completely unfamiliar with your business.
Yeah.
Maybe you've got a 360 payment loan, 30-year loan. But when you sell that note, you don't have to sell the whole thing. You can sell tranches or pieces of it. How does that work?
You can either way. You can sell part of the monthly payment, or you can sell 100% of the payment for a designated term.
Okay.
Right. So you can, you can kind of slice it and dice it depending on what the real estate investor that created the paper, like what were his goals? Is he looking for some wealth on the backside of the deal, or does he need some cash flow? And so those are the things that we've really done a lot of over the years and helped pioneer. And this is a project I'm working on, but I'm working with a ninja technology firm, and we're working very hard to bring this on blockchain.
Okay. For the notes or for the marketplace?
For
the notes. Okay. And that creates just a whole bunch more
So
security.
the efficiency of it will change, we believe, the scope of the business.
Wow. That's so interesting. So I still want to go back and make sure that people understand that there might be the payments for the first 10 years would be 120.
So easy math. Let's just say that you have a 30-year loan, it's $1,000 a month. Just easy math. You could sell, Russ, $700 a month. And I've got an insurance company that'll go buy that $700 a month, and you keep $300 a month.
Gotcha.
Or there's another way you can do it. You could sell the $1,000 payment for 10 years, and then the note reverts back to you. So you see, you got a lot of flexibility. What I've tried to bring to the marketplace are showing mortgage banking techniques to private investors.
I like that a lot. You know, the whole mission here is Main Street, empowering Main Street, which is what Main Street Media Network is about.
Yeah.
Main Street Capitalist is Main Street investing in Main Street and advocating for that.
Yeah.
I think that there are some sophisticated things that Wall Street does that Main Street could do but don't know how to do. And I think the paper side of the business has always fascinated me. That's why I ended up going into the mortgage business, but I never really got into the depth that you're in it. So you have the marketplace that you create. You've been teaching this for a long time. Talk a little bit about just Note School and what you do there.
Well, Note School really has two sides that we serve. We have people that just want to buy notes. They don't want another rent house, or they don't want to go buy a rent house at all. They just want to be the bank, right? Then we have people that come that are landlords and say, how do I walk off this ledge and create better cash flow and a lot less headache? In other words, seller finance my same property. And we've got kind of various systems and processes and training that we can help people with depending on how far they want to go, how big a business they want to build, how big is the problem they want to solve.
Nice. So you started this in 1980.
Yes, sir.
Your primary market has been real estate notes. Do you deal in any other kind of notes?
Not today.
Just real estate.
Yeah, I mean, over the years I've been involved in several kinds of alternative financing, but this has been my mainstay. You know, as you know, usually success is when you stay focused on the one thing for a long time.
Yeah. So then let's talk about interest rates, the way interest rates changed. In 1980, for anybody that doesn't remember, we were coming out of the collapse of the Bretton Woods system. In 1971, Nixon took us off the gold standard. The dollar collapsed. Inflation was raging, stagflation.
Yep.
Some people have said some of what we experienced maybe a couple of years ago was very reminiscent of the 70s and stagflation.
Yeah.
And then the Fed, through whatever mechanism, and there's debate about how it happened, but at the end of the day, in the marketplace where it matters, the interest rates were high double digits. We're talking 20%.
Right.
And then from about 1981, I think it hit the peak. It went down all the way down to the zero bound and stuck there for about, seven to 10 years, something like that.
Yeah.
And then we had this big spike up in interest rates, which from an interest rate perspective wasn't huge.
Yeah.
But from a change perspective, it was the biggest ever. It went from 0.25 or 25 basis points, a quarter of a rate, to 5 1/4. That's 20 times. And so that changes a lot of things in the finance space. The Silicon Valley Bank collapsed. A lot of balance sheets got in trouble. In your career, because you've seen the whole gamut, I understand, I think, how that affects the bond market and banking and traditional credit.
Yeah.
What happens on Main Street when those types of changes happen? Is this a more stable or is it more risky as a result of that kind of volatility with the Fed and market rates on the 10-year bond?
Best question I've been asked all week, really. And the reason is because like people don't really realize that the note buying business essentially is kind of a contrarian business. You know, I always think about Warren Buffett when I think about buying notes, right? Because we do good when other things don't do good. There's two things that make the mortgage business bad: underwriting and rates. Now, people have accredited everything to rates in the mortgage industry. The residential mortgage industry, the numbers are a disaster right now. 2021, there was $4.4 trillion in resi loans created. This year, $400 billion so far this year through Q3. Now, okay, add Q4, that's 90% off.
Yeah.
Like, so people say, well, that's because of rates. No, actually, it's probably equally because of underwriting. Because, see, remember, I just said the index is about half of what it was. So nobody accredits underwriting as even being a problem. And we believe underwriting is a big problem. So we just feel like we're filling the gap that conventional mortgages doesn't fill.
So when you say underwriting, are you saying that the lenders have become more risk averse because of I would say from the damage from their balance sheet, right? They're holding all these bonds,
That's it.
government bonds, interest rates go way
Yep.
up. Their equity goes way down because bond values are inverse of yields. And so now, because of that, they can't afford to take the same level of risk. They can't afford to make the same level of loans. So they tighten up the underwriting.
That's it.
And the underwriting is, it's harder to qualify. And of course, the contrarian play would be then private market coming in to fill that gap. You
Right.
probably have more people interested in some type of a private note. Owner carryback would probably be more attractive because you're not competing with as aggressive an underwriting standard from the conventional lenders. Is that what I'm hearing?
That's it. And if you looked at the underwriting standards that we think are appropriate, it's not loose. It's not like, oh my gosh, we're just, we're, as the old saying goes, we'll qualify anybody that can fog a mirror. No,
Yeah.
not that. But we just have found out there's a lot of gaps. There's a lot of underserved people, and we've found out seller financing is really filling a gap. So the seller finance industry production is actually up. The traditional loan originations is drastically down. So we do kind of do good when conventional lending doesn't.
It's interesting. I spent a lot of time in the gold community, and one of the correlations that I noticed, and I understand correlation isn't causation. I get it.
Yeah.
But I noticed that when interest rates went up and it created distress in the bond market, then people who would normally gravitate towards the bond market for safety gravitated towards precious metals. And so one of my contrarian plays from a portfolio management perspective was to pay attention to gold and watch for that interest rate trigger. And I started kind of sounding the alarm in our investor mentoring program that when I started seeing the Fed embarking on rising interest rates, those guys, pay attention to gold, pay attention to gold, pay attention to gold.
Yeah.
Because as these credit markets fall apart, people who are looking for a place to store wealth until they can deploy it are going to depart bonds and go someplace else. And without that money flowing into the bond market, there's less money to lend. On top of what we previously discussed, the idea that these banks' balance sheets are in trouble and they're going to be a little bit more risk averse.
Yeah.
So it's like that. I call it the water balloon, the squeeze. You squeeze it, and you know it's going to come out someplace. I don't know where the opportunity is going to come, but I know when there's a squeeze going on, it's going to be bad for one part, and there's going to be an opportunity that pops out someplace else.
Well, and I'm very familiar with the fact that gold and silver are doing really well, but somebody also can't put all their wealth in that.
Oh no!
And so if they need diversity, well,
they need cash flow.
The reports on the stock market future is not. They're not glowing, right? Right. So there's more likely than not, there's a dent coming there. I'm not calling a crash. I'm saying a dent. And then, so if you're looking at it like the fixed rate income market, our notes are what people are now doing in lieu of other things. And once again, we've been doing it for 45 years, so we have a pretty good track record of risk management, right? So we kind of know what we know how to adjust our own underwriting. We feel like that's appropriate, and so we just see a lot of people that our normal person that comes to note school probably has had real estate, and they're not looking for more. They're not looking to be a landlord one more time. But once again, we have people that do show up that have never owned real estate, and they just have all their friends that have rentals, and they say, I hear them complaining about it. I don't think I want to do the same.
Yeah. Well, from my perspective, I think there are two different types of investors. You have investors that are primarily who get attracted to the stock market, and their objective is to buy low and sell high. Some try to do it on a daily basis, day traders.
Yeah.
Other people do it with the idea that I'm going to buy it and I'm just going to let inflation grow my portfolio over time, and I hope that it outgrows actual inflation so that I end up with a net gain.
Yeah.
Real estate's always been a good play in that regard because you can add leverage and you magnify the benefit of inflation, but both markets are very dependent upon healthy credit markets. And when credit markets start to get tight, the economy slows quite a bit. And so if I'm an income investor, I don't really want to be in the stock market unless I think the idea is I'm going to build up some equity and then sell off my portfolio and live off the gains.
Right.
So then some people decide, hey, I'm going to get into real estate for income. But as we've noticed we talked before we hit the record button that there's some challenges in real estate right now,
Right.
on the expense side.
Well, this is what caused the rental property model not to work very well. It's not that anybody did anything wrong, but as you know, I'm very networked with a whole bunch of real estate masterminds. So I'm with these guys that are, call them the top 1,000 house buyers. I'm around them on a regular basis. And what happened to them is expenses went up 2.5 times higher than their rents went up.
And insurance was a big part of that.
It depends on where you are, but it's everything. Like if you're in Florida, insurance is the problem. If you're in some other state, taxes are the problem. If you're in some other state, it's hiring the plumber and what it costs to have the water heater fixed. It's that. But bottom line is the profit in there, generally speaking, I find from, well squared away landlords that know their math, they're just saying, Eddie, we're about 4% per year profit, and we were at 8%. And then so I give them some modeling. I give them like a spreadsheet and go test it. Say, would it be more profitable to continue to rent it, or would it be more profitable to owner finance it? And they come back and they go like, wow, I can't believe the math. So we're trying to facilitate that area so it's easy for them to do, but it's definitely a reality.
Well, I say do the math, and the math will tell you what to do.
That's right.
And I do think that in today's world, you got more people trying to retire, more people trying to figure out how to create income from their portfolio. Yeah. And I think the reason I wanted to do this show and introduce you to my audience is I still think even today, after all your work, after all this time, I just don't think Main Street really understands the private note business and the fact that not only you teach it, but you make a marketplace and you have the context of having been in the game for 45 years. That's a long time.
Yeah.
You've seen a lot. I have a presentation to give, so I'm going to have to break this off. But I'll tell you what, get me everything you have about everything you have. Do you have any type of a free report or anything we can offer folks?
Sure.
Okay. All right. So you don't have to even tell me what that is right now. I'll get something from you because usually you have a webinar or something like it. But if you want to learn more about what Eddie does and how you can learn how to play the note game, just send an email to noteschool@mainstreetcapitalist.com. I will get you all that information. Any questions or feedback you have for Eddie, let me know. I'll get him back on the show. We'll answer those questions for you. Eddie, anything you want to say in closing?
Just I'm fired up about what you're doing. You're trying to help an audience that I have a heart for.
Yeah, Main Street. That's my avatar out there. So thanks so much for being on the show, and folks, we'll see you next time.